For the 6 months ended June 30th, 2026, Converge continued to build as margins narrowed. Revenue growth remained positive, but cost growth, capital expenditures, dividends, and debt service created a funding gap that made new borrowing economically necessary. This review was prepared from the company's unaudited SEC Form 17Q. Converge remained highly profitable, but first-half earnings showed negative operating leverage. Revenue increased 3.1% year-over-year to 22.45 billion pesos, while EBITDA declined 1.3% to 13.27 billion pesos, and net profit declined 7.8% to 5.49 billion pesos. Operating cash flow increased 0.9% to 8.88 billion pesos. An additional 665 million pesos of revenue produced only 5 million pesos of additional gross profit, as the cost of services absorbed virtually all of the top-line increase. Higher general and administrative costs, impairment, and finance costs then pushed operating and net income lower. The bottom line was high absolute margins, but a deteriorating trend. Every major margin narrowed as the cost base expanded faster than revenue. Gross margin declined from 66.3% in 2025 to 64.4% in 2026, down 1.9 points. EBITDA margin declined from 61.8% to 59.1%, down 2.7 points. Operating margin declined from 40.3% to 36.3%, down 4.0 points. Net margin declined from 27.3% to 24.4%, down 2.9 points. EBITDA margin remained exceptional, but the decline showed that cash profitability was also under pressure. Second quarter earnings pressure intensified. Revenue increased 2.4%, while gross profit declined 3.8%, operating profit declined 14%, and net profit declined 15.8%. Gross margin compressed from 66.6% to 62.5%, operating margin from 39.6% to 33.2%, and net margin from 26.7% to 21.9%. Revenue remained positive while operating profit fell 14%, pointing to a cost and utilization problem rather than merely weak demand. Finance costs also rose 32.6% year-over-year in the second quarter. Operating cash flow was strong at 8.88 billion pesos, but it did not cover the combined demands of investment, dividends, and debt service. Cash capital expenditures and intangibles totaled 5.70 billion pesos, dividends totaled 3.55 billion pesos, debt repayments totaled 2.81 billion pesos, and interest and leases totaled 1.13 billion pesos. This created a funding deficit of 3.44 billion pesos before new borrowing. New borrowing proceeds totaled 6.95 billion pesos. Approximately 3.44 billion pesos covered the gap, while roughly 3.51 billion pesos remained as an increase in cash. The filing does not earmark the borrowing proceeds, so their economic use is reconstructed from reported cash flows. New borrowing proceeds totaled 6.95 billion pesos. The funding pool included 5.70 billion pesos of cash capital expenditures for network and technology, 3.55 billion pesos of shareholder distributions, 2.81 billion pesos of debt repayments, and 1.13 billion pesos of interest and lease payments. The resulting 3.51 billion peso increase in cash represented a liquidity reserve. Debt preserved financial flexibility, while Converge continued investing and paying dividends. The 16.52 billion peso current borrowing balance was mainly a maturity issue. Current borrowings increased from 5.60 billion pesos in December 2025 to 16.52 billion pesos in June 2026, while non-current borrowings declined from 18.50 billion pesos to 11.75 billion pesos. Total borrowings increased from 24.10 billion pesos to 28.26 billion pesos. The approximate bridge included 6.75 billion pesos of existing debt shifted into the next 12-month bucket, and a 4.16 billion peso net increase in total borrowings during the first half of 2026. Refinancing pressure rose, but the 16.5 billion peso current balance was not entirely new short-term debt. Borrowing remained manageable, but capital discipline mattered more. Net debt to EBITDA was 0.6 times, interest coverage was 17.0 times, and forward debt service coverage was 1.5 times, above the 1.2 times covenant. Return on invested capital was 14.9%, down from 17.7%. The story would improve if revenue accelerated toward the 4 to 6% guidance, EBITDA margin held at 58 to 59%. Capital expenditure moderated to improve free cash flow, and receivable impairment stabilized. The story would weaken with further second quarter-style margin erosion, refinancing at materially higher rates, dividends remaining above post-capex cash flow, or a failure of return on invested capital to recover toward guidance. The investment view was cautious, not bearish. The balance sheet could support the build-out, but future borrowing needed to translate into better revenue growth and returns.